$175 to $185 billion.
It's a number that is almost impossible to wrap your head around.
It really is. And just to be clear for everyone listening, that isn't revenue. That is a spending number.
It's Alphabet's projected capital expenditure for 2026.
Yeah. I mean, a number that big, it stops you in your tracks.
It definitely stops Wall Street.
It did. Welcome back to the Deep Dive. It is Wednesday, February 4th, 2026. Alphabet just released its full year 2025 report, and on the surface, it's a huge win.
Yeah, a massive victory lap. Revenues accelerating, they crushed estimates.
But then you dig into the guidance, you see this spend number, and it feels like we're watching a pivot point for the entire industry.
I think pivot might be too gentle.
Mm-hmm.
This is, brute force industrialization. They are spending the GDP of a mid-sized country to build the physical plumbing for AI.
It's a shock to the system.
Absolutely.
Before we dive in, this analysis is brought to you by STOCKANALYTICS.AI. Get institutional-grade research on over 600 stocks for just $10 a month, plus request any ticker and download your own video analysis. Start your 7-day free trial at STOCKANALYTICS.AI. Now, let's get into it.
Let's do it.
We've got the 10K, the transcript, analyst notes. We've organized this into 5 key slides to make sense of it all. So let's start at the top. Slide 1, the at-a-glance scorecard.
This is what I call the seminal moment slide.
Absolutely. So Q4 2025 consolidated revenue, $113.8 billion. That's up 18% year over year.
Which is just incredible at this scale.
And for the full fiscal year 2025, they finally crossed that huge milestone.
$400 billion.
$402.8 billion in total revenue. And earnings per share, or EPS, came in at $2.82.
Which completely crushed the consensus estimate. That was sitting around, what, 264?
64, yeah. We have to pause here because this breaks the law of large numbers, doesn't it?
It really does. I mean, usually when you're a $400 billion company, you're supposed to slow down. It's like gravity. You grow with the global economy maybe 3–4%.
But they're accelerating.
They are accelerating. Growing at 18% at this scale. It defies corporate physics.
It really does. But I did see a footnote on that EPS beat. I want to play skeptic for a second. Was there some financial engineering to get to that 282 number?
That's a healthy skepticism to have. And yes, a little bit. It's important to be precise here.
Okay.
That EPS number was boosted by about 15 cents. It was from a gain on equity securities.
So their investment portfolio had a good quarter.
Exactly. To the tune of about $2.3 billion. But, and this is the key part, even if you strip that out, call it core EPS, it still would have been around $2.67.
So they still beat estimates comfortably.
Comfortably. The operational engine is humming, regardless of what the stock market did that quarter. It's real profit, not just paper gains.
That distinction really matters. Okay, so the core business is strong. But what's driving that acceleration? The old narrative was that Google was just a search engine with a bunch of expensive hobbies. Slide 2, the engine of profitability.
And this is the slide that just completely changes that narrative. We're talking about the cloud.
The cloud numbers were eye-popping. Revenue for Google Cloud hit $17.7 billion in the quarter.
That's up 48%.
Almost 50% growth.
Staggering.
And the operating income more than doubled. $5.3 billion.
This is the aha moment for me. For years, the bear case against Google was that cloud was structurally less profitable than AWS or Azure.
Right, that they were just buying market share and couldn't scale the margins.
Exactly, that they didn't know enterprise sales.
Yeah.
And now they just posted a 30.1% operating margin while growing at nearly 50%. That it destroys the bear thesis. This is what we call hyper-growth profitability.
So what changed? Why is everyone suddenly flocking to Google Cloud?
It's the AI stack. You have to understand, customers aren't just renting servers anymore. They're buying the whole life cycle.
What do you mean by that?
They're buying the Trillium TPUs, their custom chips. They're using Vertex AI to build and manage their models. They're buying the entire ecosystem.
So Google is becoming the operating system for enterprise AI.
That's the best way to put it. And we know this isn't a one-quarter fluke because of the backlog. They reported a backlog of $155 billion.
Wait, $155 billion in contracted future revenue?
Yes. And that tells us that the big enterprises, the Fortune 500s, are finally moving out of what I call pilot purgatory.
Pilot purgatory. I like that. We've been hearing about AI pilots for what, 2 years now?
It's where everyone's been. Testing it, running small experiments. This backlog says they are done testing. They are signing massive multi-year deals to put this stuff into production. The checkbooks are open.
That's a huge signal. Okay, but we can't ignore the cash cow. Slide 3, the engine room business segment performance.
The engine room itself.
I feel like for the last 3 years, every other week there's an article titled, "Is Search Dead?" The narrative was that generative AI would cannibalize the blue links and kill the ad model.
That was the existential fear, right? If the AI gives you the answer, you don't click, and Google doesn't get paid.
Well, the verdict is in. Search revenue grew 17%.
17% to $63.1 billion.
And they've rolled out those AI overviews to over 2 billion users.
And here's the key. The fear was that the AI answers the question, nobody clicks an ad. But what's happening is the AI overviews are actually expanding the volume of commercial queries.
The high-intent stuff, like best mortgage rates or flights to Tokyo.
Exactly. If I ask an AI to write a cat poem, there's no money in that. But if I'm looking for travel insurance, users still trust Google for those high-stakes transactions. And they figured out how to put ads inside those AI summaries.
So AI didn't kill search, it actually made it better.
It seems to have expanded the market. People use it more.
Now, what about the other giant in the room, YouTube?
The new king of streaming.
The numbers are just wild. Total annual revenue for YouTube is now over $60 billion.
Which, to put that in context for you listening, is bigger than Netflix, Disney Plus Pieces, and Warner Bros. Discovery combined.
It's a media empire. And they're diversifying, too. They passed 325 million paid subscriptions across YouTube TV and Premium.
And that's a lot of recurring revenue. It creates a nice floor for the business, doesn't it?
It does. It reduces the reliance on a volatile ad market. Plus, Shorts monetization seems to have finally bridged the gap with TikTok.
Which was a big question mark a year ago.
Before we move on, I did spot one negative number. The Google network revenue was down 1.6%. Is that a red flag?
You know, paradoxically, no. It's actually intentional.
How so?
So Google Network is where they place ads on other people's websites. When they do that, they have to pay a fee, a traffic acquisition cost, or TAC.
Right. They split the revenue.
But when you use Search or YouTube, Google owns the property. They keep all the money. So seeing network revenue dip while their owned and operated revenue SARs is actually good for margins. Their TAC ratio compressed to about 20.2%.
So they're bringing traffic home. Why split the check if you can cook the meal at home?
Exactly.
Okay, so the business is firing on all cylinders. But now we have to talk about the elephant in the room, the number that started this whole conversation. Slide 4, financial strength and shareholder rewards.
This is the shock doctrine part of the report.
Let's restate it. Management is guiding for fiscal year 2026 CapEx of $175 to $185 billion.
And just for context, in 2025, they spent $91.4 billion. We thought that was huge at the time.
This is nearly double.
Nearly double. It's
Yeah.
an astronomical increase.
I mean, where does $180 billion even go? Are they building a space elevator? Seriously, how do you spend that in 12 months?
They're building the brain of the world. It's mostly technical infrastructure. We're talking Trillium TPUs, their custom chips, massive clusters of NVIDIA Blackwell GPUs. But it's not just the chips. It's the energy.
Energy.
You can't run clusters processing 10 billion tokens per minute, which is a metric they used on a standard power grid. They're investing billions into energy infrastructure, nuclear, geothermal. They're basically becoming a utility company just to power their AI.
So they're building the power plants to run the computers.
Yes.
Yeah.
And that brings us to the tension, because money is finite, even for Google. If you spend $180 billion on hardware, you can't give that cash to shareholders.
And we saw that immediately in the buyback numbers, didn't we?
We did. Share repurchases slowed at just $5.5 billion in Q4. That's down 65% from the prior year.
That is a massive drop. Google has been a buyback machine for years.
Well, that support is gone for now. They've made a choice. Infrastructure over share reduction. They're telling Wall Street, we're building the future, not propping up the stock price today.
And free cash flow took a hit, too.
Yes. Operating cash flow grew 34%, so the business is printing money. But free cash flow declined by 1% because every spare dollar is going into concrete and silicon.
And you mentioned something earlier, a depreciation cliff. What does that mean?
This is the bear case. This is the danger. All this hardware, it has a useful life of maybe 3 to 4 years.
So it wears out, or a faster chip comes along.
Right. So in 2027, 2028, That $180 billion spend is going to hit the income statement as depreciation expense. It will crush their profit margins if revenue doesn't keep skyrocketing to cover it.
It's a race against time. The revenue has to show up before the hardware gets old.
Precisely. It's a high-stakes bet.
Speaking of the future, let's look at where they think this is all going. Slide 5. The road ahead management's outlook and key takeaways.
And this is where we see the other bets finally starting to pay off.
Specifically, Waymo. It feels like Waymo has been in R&D mode forever. Is
Wow.
it a real business yet?
It's finally graduating. Waymo just raised a $16 billion external funding round, and Alphabet took a $2.1 billion charge to revalue employee equity.
This sounds like accounting jargon. Why is that important?
It's about retention, the talent war. They're repricing stock packages to keep their engineers from leaving. But the $16 billion in funding means Waymo is moving from testing in a few cities to national scaling.
So the robotaxis are actually coming.
They are.
Now, you mentioned something at the top of the show. Sovereign AI. This seems to be a new buzzword from management. What is it?
This is a fascinating new moat. The idea is that nations, Germany, Japan, India, they all want to own their own AI models. They don't want to rely on a model trained on American data. They want data sovereignty.
Okay, that makes sense. They want control.
But to build a sovereign model, you need massive infrastructure in that country. Alphabet is positioning itself as the arms dealer to the G20. They'll build the infrastructure for you so you can have your sovereign AI.
Wow.
Right.
So the customer isn't just a company anymore, it's a government.
Exactly. And that explains the $180 billion capex. You need a data center in Berlin, in Tokyo, in Riyadh.
It also explains why they're willing to take the hit on cash flow. They're trying to price everyone else out of the game.
That is the land grab logic. Management basically said the risk of underinvesting is existential. By spending this money, they create a barrier to entry that startups like OpenAI or Anthropic just can't overcome.
You can't afford $180 billion in hardware a year.
You can't. You have to partner with a hyperscaler. So it turns the market into an oligopoly. You have Google, Microsoft, Amazon, maybe Meta. Everyone else rents from them.
That is the end game. Any other risks here besides that depreciation cliff?
Regulatory risk is always there. They mentioned the ad tech litigation and EU fines. But honestly, it feels like the regulators are fighting the last war. They're worried about ad tech while Google is building the infrastructure for the next world.
Okay, let's try to wrap this up.
It's a complete picture.
Outro. It really feels like a split verdict here. If I'm a trader, I'm looking at the drop in buybacks, the cash flow compression, and I'm nervous. The stock might be dead money for a while.
That's fair. The short-term shareholder is paying the bill for the long-term dominance.
But if I'm a long-term investor,
If you're a long-term investor, you look at 48% cloud growth and 17% search growth, and you see a business that's stronger than ever. The terminal decline narrative is dead.
and that CapEx number, as scary as it is also a statement of power.
It is. Alphabet is digging a defensive moat so deep that it turns compute into a utility that only 3 companies on Earth can afford. They are trading near-term cash for total dominance of the AI era. It's a bold bet, and they have the bank account to make it a reality.
A bold bet indeed, and one we will be watching very closely. That brings us to the end of this deep dive.
Always a pleasure.
Disclaimers. Not financial advice. Do your own research. Generated by AI. Want institutional-grade stock research without the institutional price tag? Check out STOCKANALYTICS.AI. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at STOCKANALYTICS.AI. Make smarter investment decisions with research you can trust.